Hi guys, welcome to Talking Money with Nozi, personal finance made simple. If you want to reduce your taxes as an investor, it is important to know what type of taxes there are for different types of investments and how this tax will affect your investments. This will help you to plan your investments in the most tax efficient way. Whether you're earning interest from your cash or bond investments, rental income, or dividends from shares or ETFs, you will have to pay tax, unfortunately. In the next slides, I discuss different taxes that are payable for different types of investments. Any interest that you earn from your cash, bond, and unit trust investments will attract tax. If you are under the age of 65, any interest that you earn up to an amount of $23,800 is tax-free. If you are above the age of 65, any interest that you earn up to an amount of $34,500 is tax-free. Any interest that you earn above these limits will be taxed at your marginal tax rate and could range from between 18 to 45%, depending on where you fall on the SARS income tax tables. Then there's dividend tax. If you invest in dividend-paying shares or ETFs, 20% of your dividend is taken by the company that is paying the dividends before the balance is paid out to you. If you receive income from your rental properties or real estate investment trusts, you can pay tax of between 18 to 45%, depending on where you fall on the SARS income tax tables. When you sell some or all of your investments for a profit, you will have to pay capital gains tax on that profit. Capital gains tax ranges from 7.2 to 18%, depending on where you fall on the SARS income tax tables. Those are a whole lot of taxes to pay, right? What if I told you that there is an investing account that prevents you from paying most of these taxes? It's called a tax-free savings account. A tax-free savings account allows you to invest in cash, bonds, property ETFs, and equity ETFs without you having to pay income tax, local dividend tax, or capital gains tax on the returns from these investments. Actually, I wish that the tax-free savings account was named a tax-free investment account because the word savings makes people think that tax-free savings accounts are for saving. They are not for saving. Tax-free savings accounts do not work like normal savings accounts, and they are more beneficial when used for long-term investing rather than for short-term saving. So, let me break down tax-free savings accounts. They were introduced to South Africa in March 2015 as a way to encourage people to invest for the long term. With tax-free savings accounts, you will not pay any interest tax from cash, bonds, or unit trust investments. You will also not pay any dividend tax from South African companies. You will not pay any property income tax from your real estate investments. And you will not pay any capital gains tax when you sell your investments for a profit. Where can you open a tax-free savings account? Tax-free savings accounts are provided by licensed financial service providers like banks, unit trust companies, insurance companies, and stockbrokers like Easy Equities. What type of tax-free savings accounts are available? Financial institutions like banks, unit trust companies, and stockbrokers offer different types of tax-free savings accounts. Tax-free savings accounts can be cash-based, fixed-term bank accounts, unit trusts, or exchange-traded funds that are listed on the stock exchange. Since I am investing for the long term, I prefer to invest in equity-based exchange-traded funds because equities, which are shares, give better growth than other assets. You can watch this video here or over here where I compared the returns for cash, bond, property, and equity investments. In that video, I mentioned that shares or equities are high risk, but also offer higher returns over long investment periods. How much risk you can afford to take depends on how long you are investing for. If, like me, you are investing for a long time, like more than 10, 15, 20, 30 years or even more, you will gain the most benefit from investing more of your money in growth assets like property and equity ETFs. How do tax-free savings accounts work? Deposits to a tax-free savings account are limited to a maximum of 36,000 Rand per year and a maximum lifetime limit of 500,000 Rand in total. It doesn't matter if the balance of your tax-free savings account grows beyond these limits over the years. It is the money that you put in that is limited to 36,000 Rand per year and 500,000 Rand in total. Any deposits above the annual limit will be taxed at a rate of 40%. I repeat, the contribution limits apply to your deposits only. Your money is allowed to grow and multiply inside of this account beyond those deposit limits without attracting any tax. The most beneficial way to use a tax-free savings account is for long-term investing. Use your tax-free savings account for long-term investing and don't withdraw early. Whatever you withdraw counts against your annual and maximum lifetime contribution limits. For example, if you deposit 36,000 Rand today and you withdraw all of that money next month, you will not be allowed to deposit any money into your account this year because you've used up this year's annual limit. Withdrawals also reduce your maximum lifetime deposit limit. So for example, withdrawing that 36,000 Rand will permanently drop your lifetime deposit limit from 500,000 to 464,000. So it is not worth it to use your tax-free savings account as a short-term savings account. How many TFSA accounts can an individual have? Anyone, even children, can have more than one tax-free savings account, but the annual limit applies to all your contributions in total. So for example, in 1 year, you can invest 10,000 Rand with Bank A, 16,000 Rand with Unit Trust Fund B, and 10,000 Rand with Stockbroker C. So the total must not go above 36,000 Rand. If you decide to contribute the maximum of 36,000 Rand per year, you will reach your 500,000 lifetime limit in 13 years and 8 months. When you reach this limit, you will no longer be able to make any additional deposits, but you can leave your investments to grow through compound interest and multiply your money over long periods of time. What would happen if you left your money to grow for 15, 20, or 30 more years? Let's see. If you were to invest 3,000 Rand per month, which is 36,000 Rand per year, for 13 years and 8 months, at an 8% annual growth, your investments will be worth approximately 868,570 Rand. Since you would have reached your maximum contribution limit, you can no longer add any more deposits, but you can leave that money to grow. So if you left that 868,570 to grow for 15 more years at 8% annual growth, you would get approximately 2.75 million Rand. If you left the 868,570 Rand to grow for 20 more years at 8% annual growth, you will get approximately 4 million Rand. If you left that 868,000 to grow for 30 more years at 8% annually, you will get approximately 8.7 million Rand. Guys, I hope I have managed to convince you about tax-free savings accounts. They are awesome. As an investor, a tax-free savings account will save you from paying capital gains tax, local dividend tax, and interest tax for any income that you earn inside this account. Here are some practical steps that you can take. Number 1, open a tax-free savings account. I personally use the account that is provided by Easy Equities. Number 2, start investing now, even if the amounts are small. Number 3, invest regularly. Number 4, be patient and allow compound interest to grow your money. That's it, guys. If you have any comments or questions about tax-free savings accounts, please leave them in the comments section below. If you'd like to see more of my videos, please subscribe to this channel. Bye guys, I will see you in the next video.